Welcome to our session on Africa's economic momentum. It's a pleasure to moderate this session and to be joined by a great group of investors. Please join in welcoming Franklin Amu, co-founder and managing partner at Bailey's Emerging Markets; Abdelaziz Abdel Nabi, CEO of Catalyst Partners Egypt; Sithe Gumede, partner at Sanari Capital; Benga Hassan, managing partner at Argentil Capital Management; and Edmund Higginbottom, managing director at Verdant Capital. I guess before we dive into the discussion, I'll give you a minute to introduce yourselves. Franklin, we can start with you.
Hello, can you hear me?
No.
Hi, good morning. My name is Franklin Amo. Excuse me, I'm the managing partner of Bailey's Emerging Markets. We are a specialist investor in industrials, digital infrastructure, and telecoms. Thank you.
Hi, good morning, everyone. I'm Abdelaziz Abdel Nabi. I'm the co-founder and CEO of Catalyst Partners Holding. We're a full-fledged investment bank that basically focusing on the MENA region. Thank you.
Hi, everyone. My name is Sithe Gumede. I'm a partner and executive director at Sanari Capital. We are a growth stage private equity firm based out of Johannesburg, but investing in the rest of Africa, sub-Saharan Africa.
Good morning. My name's Ed Higginbottom. I'm managing director at Verdant Capital. Verdant Capital is the manager of the Verdant Capital Hybrid Fund. We're a $70 million fund investing mezzanine capital specialized in alternate credit and digital finance. We have a sister company, which is Verdant IMAP, which is a M&A advisor, private capital markets advisor. Both our business operate on a Pan-African basis. Between the two businesses, we do 20 transactions a year. We do investments from our fund in the range of $3 million to $20 million, and we do transactions in our private capital markets advisory, M&A advisory business of between about $10 million and $250 million.
Hi, I'm Benga Hassan, managing partner for Argentil Capital Management. Argentil Capital is an investment and a financial advisory business, primarily operating in West Africa. On the investment side, we cover primarily Nigeria, Ghana. We invest in SMEs across agribusiness, consumer, clean energy, and tech-enabled businesses. We've deployed in excess of $50 million into investments that we've made. We've had about 7 exits, and we're raising a larger $75 million fund. Thank you.
Thank you all. So just to set this scene, I'm briefly going to share some data points from AFSIC's latest research. First of all, 2024 marked a welcome period of stabilization for Africa's private capital industry. After years of volatility, we saw stability return in key markets. South Africa and Kenya both ended the year with inflation below 4.5%, while fund managers across the continent maintain a cautious but active position. According to AFSIC's latest data, 485 investments were closed in 2024, totaling $5.5 billion. That's an 8% increase in deal volume year on year, which is the second highest on record. And then for the first time in a decade, we saw that deals below $50 million accounted for more than half of the total deal value. On the fundraising side, Africa stood apart from global trends. We saw African-focused funds raise $4 billion in final closes, more than doubling year on year. And also on fundraising, it's worth mentioning that Africa-based investors now account for nearly 1/5 of total commitments, with that share rising further to 25% in the first half of this year. Also, what we see in 2025, in the first half of the year, that is, the story remains one of resilience and stabilization. So we saw 215 deals closed in the first 6 months at $1.9 billion. So holding steady year on year. We also saw infrastructure and private debt now being one of the fastest growing strategies. So today's conversation is really about translating that resilience into long-term prosperity. I wanted to open the conversation by just touching on what I just mentioned. The first thing I think is worth talking about is, as I mentioned, that the smaller ticket deals below 50 million made up more than half of the total deal value, which is the first time that has happened in a decade, and large transactions have almost disappeared. So I just wanted to understand, like, what does this mean for you that are on the ground? Sita, maybe we can start with you.
Yeah, I mean, I think for us, particularly in the place that we operate, in the market that we operate, that actually it makes sense given the nature of not just South African but African businesses, the size of it, and where the sort of the economic momentum comes from. It's these types of businesses, smaller type of businesses that are looking to scale and to grow, and are like a huge source of innovation for Africans as a whole. So I think for us it makes sense that you're getting a lot of these deals and they're taking over the sort of the broader market, because that's where the momentum is, and that's where most of the opportunities are for growth and scaling. And we know that the private equity model is changing away from sort of like the traditional sort of leveraging the businesses in order to generate returns, more towards sort of enabling growth, enabling job creation. I think that's important in the African continent, and it makes sense for us that the industry is moving towards more of those deals that are providing that sort of growth lever, as opposed to optimizing the business for returns.
No, absolutely, thank you. And then Franklin, you operate in other regions outside of South Africa, so what are you seeing?
Yeah, no, I would echo some of what Silje said, and I would also point to the history of our industry. I mean, many of us have been here over the last 10 years that you're talking about and seen the evolution. I think there have been two big trends. One is funds are smaller, and therefore they focus on smaller allocatable deals. And I think that in and of itself was a response to what I guess Africa Private Equity 1.0 found was when the original sets of GPs tend to be much larger and frankly struggle to deploy into the ticket sizes that they were set up to look for, and more importantly struggle to exit. So I think I've heard from other, we're relatively small, but I've heard from friends of mine who are managers of even much larger funds, and even with much larger funds, have said that they will stick to looking for smaller sized deals because they've run into the issue that when they try to exit very large transactions, they tend to be talking to a small audience of buyers. So I think that will probably continue, and as I said, I think that's probably for the better, because I think when you think about where these economies are, think about the sort of part of the development cycle that they're in, the real need for growth and the real sort of opportunity on a return on capital perspective is really in smaller businesses with smaller enterprise value and providing capital to them.
Thank you. And Ed, I think you had some views on the smaller ticket size deals that we've seen.
Being slightly brutal, we call it the exitable size range. And we do see smaller funds in average in the African continent, but on the flip side, we see a lot of pressure and bias almost from the LP community and the DFI community towards larger funds of 250 to 500 million. And early in the morning, I know, but let's just do a little bit of mental arithmetic. You've got a $500 million fund. You're allocating, in theory, to 10 deals. It's $50 million per check from your fund. You have to have co-investors now and everything. So let's say it's $75 million, including co-investors. Well, let's say that we're investing 75% of the company, that the equity value at the time of investing is 100 million. Let's look at the debt. There's debt on the business as well. Well, let's call it a $200 million enterprise deal. So I've got a $500 million fund. I'm investing in businesses with enterprise value of about $200 million. Well, let's say I'm going to do a good job as a GP, and I'm going to get to an IRR, gross IRR in the high teens. I'm going to exit after 5-6 years. I'm exiting at 2x. So I've got, just in my fund, as a $500 million fund manager, I've got 10 companies I've got to exit at $400 million enterprise value. Okay, let's say I don't have a $500 million fund, I've got a $250 million fund. Hey, I've got to exit 10 deals at $200 million enterprise value. There's not the buyers for that in the regional market. Yes, there's strategic buyers around the world, and say Verdant IMAP, we do a lot of deals with strategic buyers around the world, but it's fickle. Sometimes it works, sometimes it doesn't work. In fact, we see more sellers than buyers at the moment for assets in Africa from the global community. Still buyers in Asia, some buyers in Europe. So as a community, as an ecosystem, even with fewer large funds, with the absence of a really working dynamic IPO market, either in the continent or in London or New York or elsewhere for African companies, with the absence of that IPO market, as a community, as an ecosystem, we're building up big problems for ourselves in 5-10 years' time, just because of the sizes of the deals we need to exit. And this is we're talking about the problems and the deals that are going well. This is not even getting to deals that went badly or fund managers who did badly. This is actually the ones who do well. Is that we are creating issues with ourselves, and I think fortunately, because of the dynamics in the market and because of the number of managers in the market and the sort of the best deal sizes, we are still seeing the average fund size lower than smaller, and because of that, we are still seeing a lot of deals done which are at that exitable size range.
That's very insightful. Thank you. Before we get into the two themes of the panel, the other data point that I mentioned was about where the capital is coming from, with that increase from local capital investors coming in. How is this changing the conversations with LPs as you are when you're fundraising? Benga, I don't know what you're seeing in Nigeria.
Yeah, so thanks, Alfonso. I think, as you noted, the trend has seen, I think you said 25% now is, in terms of the latest data point, is coming from local investors. And we have always felt that has been a significant pool of capital that is missing in the asset class. And if you take Nigeria, for example, it hasn't done very well in that. I believe the data is that the pension funds manage probably just around under $20 billion of assets. Traditionally, 10% of that should go to private equity or and infrastructure. I think so that's about $2 billion. I think we've barely done $200 million. So there's a 10x gap. But the interesting thing is, recently, the PENCOM guidelines have actually increased the allocation, thanks to the work of AFCA and other systems and engagement with the regulator. So we actually have a bigger pool of capital that can be deployed. So if you look at the delta, where there is an additional pool of $2 billion that can come into private equity or infrastructure funds in Nigeria alone every year from the PFAs, right? And if you look at the data point, the DFIs are pulling back. That's the reality. Different things around spending more on defense in the economies, less cut. There's a cut in development finance, etc. So the reality is, as a ecosystem, we have to provide structures that allow the pension funds to deploy capital into the asset class, because unfortunately the pension funds have just mostly packed their capital in fixed income instruments. They've essentially funded government debt, which, again, government isn't the best allocator of capital, right? So from our perspective, we think that we're seeing that trend, and will very much continue to support the likes of AFCA, PEFCA, other institutions that have been at the forefront of getting these PFAs to understand the asset class, understand the risk rewards that comes with that. And the other point, just to add, is that I think it's also come as a result of necessity. A lot of them that have put their money into fixed income, if you look at Nigeria's inflation for the last 5 years, they've been underwater, right? So the T-bills or the fixed income rates have been lower than inflation. So from a return perspective, they've actually delivered less value. So they've lost value for pensioners. So they are also under some pressure to actually give risk-adjusted returns. So alternatives continue to provide that sort of base. Thanks.
Thank you, Benga. And is the situation similar in Egypt, Abdelaziz?
It's very interesting because what you guys mentioned is actually very similar to what's happening in Egypt, I would say. The thing is, I just want to go back a little bit. It's just SMEs or the mid-sized companies, they represent 85% of any emerging market. So I'm talking about from the Egypt country, and I mean in Africa, it's basically the majority. So it makes a lot of sense that all the private equity and all the private investments, now it goes to the sector, which is completely what we call is the underserved, or the, let's put it this way, the ones that are not looked at, whereas the majority of the workforce, the majority of any kind of growth would come from these companies. And even the conglomerate or the big institutions, they always tend to, if you look across the M&As globally, not only in the region, it always goes to these kind of like smaller companies that were brought up from entrepreneurs or businesses, and then they become much like a more corporate a little bit, and then they get acquired from the multinationals. Having said that, we see, again, the trending that's happening, of course, with the lack of DFIs of the world that's happening now, political reasons, wings, whatever that's, we want to call it, political aspects of things. So we're starting seeing much more capital coming from within. As my colleagues mentioned, is because the returns are not as supposedly like not hitting the inflation, so they are thinking of other classes. And this is, I think, from a professional perspective, and where our role is that we present for them different asset classes, different structures, unconventional things that would make them interested, and to basically tick their boxes to be able to understand. Again, this will take a bit of a time for the locals to understand, instead of getting into fixed, into more riskier asset classes. Again, from the DFIs, when they come along, they will see that this is a new norm, let's put it this way, that they have to downsize on the sizes that they're looking for. So again, from Egypt perspective, yes, we're seeing it. We see, of course, as all the African continent, what we see from fresh cash or, let's say, new funds, it's like water vapor, just droplets. That's basically tapping or getting into the region. Whereas, sorry to say that, but I mean, if you look at all the growth, it's coming from the African continent. It's coming from the emerging markets. Like the returns that, I mean, Europe, the US, don't get me wrong, they're not, they don't give you the same returns that we can get from the right investments in the African continent. Thank you.
Alfonso, maybe I can just make a comment, which I think is directionally very similar to Benga's point. The DFI community, the international LPs, are asking for more local pension fund participation. It's a KPI for the development banks, but they've got to let them in. As a community, we've got to make sure the international LPs let in LPs from our world, local LPs. What do I mean by that? So we have one size fits all, one structure fits all from the international LP base, which is the 2 and 20 LPGP model, 5 plus 5 plus 1 plus 1 plus 1 plus 1 plus 1. We have, sorry, forgive me. We have a standard LPA that they all think is, that the international LPs think is appropriate. But actually lots of different fund structures work better around different asset classes. So even opening up the asset class to private credit has been a big push. You know, one DFI said to me, we do one credit fund a year, and that's all. Well, great, you're doing a credit fund every year, but is that the right allocation for the African continent? Is that the right allocation for your own taxpayers? Because we can debate the answer to the first question, but there's no debate about the answer to the second question. We need to have a little bit more innovation in the structure, or a little bit more openness to different structures. Secondly, the thematic overlay. So gender is very, very important. 2X is very, very important. E&S is very, very important. But that thematic overlay onto GPs and onto GPs' priorities and the reporting that goes around that can be very, very onerous. And some of the equity funds who've not hit their return hurdles, or they've not hit an acceptable return, some of those equity GPs are saying that that thematic overlay and the distraction and all the things that go along with that, that's one of the contributing factors towards a lower return. Well, if I'm an African GP, I'm a pension fund, I want a return for my pensioners. We're not a rich part of the world. I want to deliver a return to my pensioners. I don't care what the latest thematic overlay is from a continent that's 10,000 miles away from me. So if we are going to let the local investors into our asset class, there does need to be some watering down of that thematic overlay. There's got to be some balance. We've got to allow those core commercial objectives to come through, and we've got to allow broad-based economic development to be the thematic priority rather than the more complex thematic overlay.
Thank you, Franklin. I think you wanted to add
Yeah, I think Ed touched on some of the themes, but I don't want us to underestimate how big sort of contributing dimension this is going to be. I think the number 25%, I think you said, is currently local capital. It's only going to grow for all the reasons that have been said by the panelists. ODA is a dying industry, unfortunately. For very obvious and sanguine reasons, I think those trends will continue and probably intensify. And I think the retreat from ODA is going to grow, not reduce. And so, out of necessity, I think local capital, which should have always been sort of the bigger driver, is going to be a bigger factor. And I think local capital investors, and this is what Ed was starting to hint at, have very different demands. And so I think the industry is going to be responsive to where capital comes from. And I think that will create very, very different businesses for all of us who are in this industry now. I think we have all grown up sort of under the tutelage of the DFIs with very specific requirements. They're looking for very specific things. And if you've ever sat with an African institutional investor or allocator, you'll recognize, in 2 minutes, you talk to a very different audience, and they have a very different set of expectations and requirements. And I think it's going to be the biggest change to this industry that we're all in.
Thank you. I think that's very insightful. I guess with that in mind, let's bring the conversation back a little bit to the topic of the panel. I just wanted to get a bit more into the specifics. And I wanted to start with you, Abdelaziz. You created the first PAC in Egypt, and I think you are in the process of finalizing 2 transactions, which is going to bring the capital to over 3 billion Egyptian pounds. So tell us a bit more about that process and what that means for Egypt.
Okay. The thing is that all of us as panelists, we discussed that we need to do different asset classes, doing different things to attract new money into the region. Having said that, we thought of it in Catalyst Partners team is to create a SPAC, a special purpose acquisition company. We are fully aware that it was not very successful in the US. Of course, some of them were very successful. Of course, we studied it very well. It took us a lot of time to study the failures more than the successes, to understand where the drop holes or the loopholes that we were able to mitigate to make it successful. And this took us, of course, with the regulator in Egypt, which was very supportive, that it took us, we handheld each other, took us step by step to be able to reach where we are today. So actually we launched the first private SPAC in the Middle East last year, November 2024. And we did a basically private placement, was oversubscribed 2.5 times from private investors, local ones that basically understand the business. We, of course, discussed it with them. They knew what we're getting into exactly from day one. And how we discussed it is that we roll out the whole roadmap until the end. There are things that, of course, the market was not aware of, but the regulator, investors, everyone is intact, in line, where we're going and all the steps and how we're moving on. So we finished the private placement 2.5 times, subscribed on the stock market in Egypt, which is called the EGX, was basically done. After that, we already identified 2 investments. Usually in any SPAC is single, most of them, not all of them, are single investments that these SPAC, again, I don't want to get into too much terminology, I'll try to simplify it as much as possible. So usually they invest into one company and then they de-SPAC it into the mother company which is listed on the stock market. What we were able of doing is that we acquired 2 companies to give them the essence of both worlds. We acquired 100% in a full-fledged investment bank, which is Catalyst Partners, that I'm basically representing, and another fintech, which is called Qardi. It's an online fintech platform, which gives the essence of a very high growth unicorn financial institution, which is a fintech, and another one, steady, ready-made, like typical investment bank that's basically has a typical cash flows, peers, and all these things. So it gives the essence of the investor to have both worlds in one pot. And this is where we, as we mentioned, unconventional or new asset class that would basically attract different type of investors. So luckily, we were able of executing that last week. So this is a new information that actually was publicized in the stock market. We already acquired them, and we're just waiting for the regulations that basically within the next week or 2, it's going to be traded on the stock market. So actually the acquisitions were actually successfully done. 100% acquired, the SPAC acquired 100% the Catalyst Partners holding and acquired Qardi. Both of them were fully acquired and to be traded on the stock market. And coming up next, we have something I cannot disclose now because it's still in making, but I mean very soon, before the end of the year, we already have another phase that was discussed from earlier with all investors to make it liquid, accessible, fresh cash, everything that makes it, again, we believe this is a beginning of more to come for more unconventional structures that needs to be done for what we see the Middle East and Africa. And having said that, sorry to take so much longer, but again, we saw similar markets, for example, like Saudi Arabia. They just launched the regulations of the SPAC a month or 2 months ago. To be honest, they even requested from us the lesson learned and how it's done. And the thing is, we see that opening, and we hope to become a beginning for more African markets to adopt this SPAC perspective or vehicle. Thank you.
Congratulations on that. And I guess moving from Egypt to South Africa, we were talking about the rise, the increase of capital coming from local investors. And Sitha, I guess Sanari is behind those numbers because you raised recently your 80 million fund, and you attracted some of the largest South Africa institutional investors. So how was that process?
Yeah, I mean, I think it's important to note to the previous discussion. So we raised about 85 million rand capital, 100% from local allocators or pension funds in the South African economy. And that's not out of not trying to get international DFIs. We tried. But to the points mentioned before, you know, there's expectations, there's structuring issues, there is, you know, sort of expectations that are different from what local providers would require. And again, there's this sort of dynamic between, you know, the requirements of the local providers or capital providers versus what the international DFIs want. So I think for us, it was very encouraging to be able to raise that level of a fund and meet our target final close from local providers in the South African economy. I think we cannot sort of underestimate the regulatory changes, and I think Benga sort of spoke to it, and Franklin as well. I think it is important for the industry as a whole to sort of galvanize this change and this sort of improvement of regulations towards more sort of alternative assets and alternative allocations. I think what we've seen, again, to the previous discussion that was had, is, you know, this is where the sort of the momentum of the market is these sort of smaller types of assets are driven by the type of sort of equity providers and investors like ourselves that are driven by these models on the back of the local operators. We are smaller, and a lot of other allocators in the market have allocated to what we call sort of emerging fund managers, either first-time fund managers or, again, sort of smaller type of fund sizes. But these are the assets themselves, and the people behind these private equity funds are very experienced individuals. The challenge there is that you find that because the fund manager itself is new, even though it's got a lot of experience behind the individuals in that fund, the challenge that the local allocators usually have is the experience of the fund manager as a whole, and the team dynamics and the ability for the sustainability of that fund to continue. So that is what we find as a challenge, and I think there is work in the industry to try and sort of speak to that, to those challenges around how do you allocate appropriately to emerging, what we call emerging fund managers, that enable this layer of participation of assets that provide the growth and provide job creation and innovation in the South African and broader African context. So I do think it's important that as an industry we sort of come together and think about how we help both the regulators and our local allocators to think about how better to enable the industry in order to further enable the participation of those local allocators to the market.
No, absolutely. Thank you for that. I think I also wanted to touch on the long-term gains of PE as an asset class. So, Benga, what I wanted to hear from you, because I think I've seen Argentil really emphasizes active portfolio management. So what kind of systems do you have in place to make sure that your portfolio companies are able to generate that long-term gain?
Thanks. Yeah, so we are very active managers. So, and one of the things that we work with during the due diligence, I mean, first of all, we actually will take a lot of time to assess a management team or sponsor before we deploy capital. Because for us, that alignment is very important. And they have to see the value that we bring is just beyond capital. If a sponsor just wanted us to give capital and then go to bed, we wouldn't back them, right? So that alignment is something that from day one, we kind of have to be aligned. And as part of our due diligence process and getting final approval, we will develop some plan around implementing from day one. We call it our stakeholder value plan with the sponsor. And, you know, again, I think sponsors that we've done very well with appreciate that. And, you know, a lot of that isn't, we're not doing anything magical. We're just trying to ensure, one, that the business is able to achieve its growth strategy. And to do that, the business would need additional financing. We have the skills of being able to support them to raise additional financing. Some of them would need technical operational experience. We're able to use our network. And in fact, one of our portfolio companies, Cygen, was, I think, under manufacturing. We got them into the Manufacturing Africa program, and they've been able to benefit from that in terms of getting towards operational excellence, right? Corporate governance is very important. I think, it's very important that businesses report and perform per regulation, because when you come into exit, the last thing you want is to see that the business hasn't been paying taxes or has been doing stuff that's funny, and that now becomes an issue. And then, the other things that we look at is when we're investing, we also look at who are potential exits. So we're not waiting until a couple of years down the road to start doing a beauty parade to identify a buyer. We're actually connecting the business with these potential partners, right? Because our view is that if you've done business with somebody as a strategic trade buyer, you're more likely to look at that business if I'm exiting, right? So again, for us, there are levers that we've developed, and like I said, we found out that having the right conversations with the sponsors at an earlier time is key to ensure that when we are pulling those levers, even though there could be tension, because sometimes you're not always going to agree with it. Because I mean, an entrepreneur has, especially the successful ones, have been good at what they're doing, right? So the last thing they want is somebody telling them how to do stuff that they've been good at doing. So, but if they're open-minded and they understand that you're both working to achieve a common objective, and they see the value, that's very important, right? They see that value that you're bringing in. Then they would actually, if I use the word, bend to accommodate that. So from our perspective, and that has meant that even in challenging environments, I mean, Nigeria, we've had a 4x devaluation over the past 5 years. We've been able to...
Welcome to the party. Welcome to the Egyptian party.
yeah, it's been tough. We've been able to deliver two to three times X on some of these exits or further capital rounds through that value addition, right? So it does work, but it's roll up your sleeve and get busy and dirty, if I can use that word. Thanks.
Thank you, Benga. Franklin, I also wanted to hear your views, because you primarily focus on manufacturing and industrials, which is not attracting as much capital as tech, for example. So how does your input translate into value creation on those sectors?
Yeah, no, thanks for the question. I think it's actually for the reasons in the question that we look at those sectors. First, it's mission-driven. I think we founded this business to finance the industrialization of the continent. We thought that was the big sort of macro opportunity we were chasing. When you look at the demographic indicators, a very large and growing young workforce, but you need to sort of put them to productive work to make that demographic dividend a reality, and so on. And then, because these were overlooked sectors, at the time, logic kind of sort of suggested that value could be there. And we've seen that in terms of entry multiples into manufacturing businesses. You're talking single-digit EBITDA multiples typically, relative to technology and faster-growing businesses where the multiple is typically much higher. The second sort of attractive characteristic about manufacturing and industrial businesses is what Benga's talking about in terms of coachability of management. Management and production processes are generally fairly well understood in most cases. I mean, there's some innovation, but typically you sort of know how the sausage is made, so to speak. And so usually the entrepreneur, the founder, the controlling management or shareholder, whoever, understands what the right way to do things are, and there are barriers to them doing those things in the most productive, efficient, sort of most attractive unit economic metric sort of way. Typically capital, typically a lack of management depth, meaning that you have a very experienced founder, senior management, and then below them sort of a gulf until you have kind of labor and not much in that middle management bench. And so they need that support. And so again, echoing what Benga said, I mean, a lot of investing in manufacturing industrials in Africa is rolling up your sleeves. It's very interventionist. It's very hands-on. I actually began this business on the bones of a family-held industrial business in Nigeria, and saw a lot of the mistakes that older generations of management have made, and that was kind of one of my inspirations for wanting to support industrialists in Africa, the fact that they do not have access to capital. One of the things I think that we've done well, and also the industrial side lends to this a lot better, is sort of matchmaking and pairing portfolio companies with larger established businesses, either in their supply chain, in their ecosystem, vendors or customers, both domestically and internationally. And again, it's multiplicative impact. First, it's the sort of coaching, the sort of potential for sales and transactional relationships, but also, yes, indeed, the potential for seeding a potential exit into one of those partners. And we've had a lot of success with that, particularly from the Asian part of the world, because they see the local portfolio company as understanding distribution, regulatory environment, customers, and all of that, while they bring capital, know-how, better tooling and machinery, and some of those management techniques. So yes, it's been a sector that we've liked, and it's a sector that we're actually planning to double down on significantly going forward.
Thank you, Franklin. Sorry, we are running out of time. I have a final question for Edmund, and hopefully we can squeeze some final remarks. But Ed, I wanted to see your view, because Verdant not only does the fund management side of the business, but you also offer advisory and debt restructuring. So with all those tools within the business, how are you able to support the ecosystem as a whole?
I think it gives us a lot of flexibility, a lot of visibility. I think in terms of returns on credit and returns on mezzanine, I think there are structurally better returns outside South Africa than domestic South Africa. I think in terms of our visibility and our reach and our market know-how, that does enable us to deliver meaningfully higher currency-adjusted returns to our investors than domestic South African or predominantly domestic South African credit or mezzanine players. I think in terms of the challenges in the ecosystem as a whole, the two challenges that we see, currency and exits. I think the exit market is challenging, but as given our exposure to the M&A markets and our expertise in the market, I think it's relatively less challenging than it's reputed in the ecosystem. I think a lot of discussion around exit and lack of liquidity. Yes, in some cases it's real market liquidity, but a lot of the time it's valuation, and the valuations on the way in 5, 7, 10 years ago were just too high. And it's a little bit as a community that's sort of facing up to that fact, and that the community's lost capital by overpaying, and we're not going to restore that loss of capital by holding on to assets another 12 months, 24 months, 36 months, and helping everybody come to terms with that. I think it's important. It's important for Verdant as a M&A advisor, but it's also important for the ecosystem that we sort of manage those expectations.
Yes, I don't know if it's possible to have a 2 minutes more to do final remarks. Sadly not. We don't have time also for a Q&A, but the speakers are going to be around today. So if you have any questions, you can address them directly. Thank you very much.
Thank you.
Yeah.
Alfonso, thank you very much.
Thanks a lot.